guys, welcome back to the Capital Mindset Show. Today, we're going to be looking at Magna International. For those of you who don't know about what this company does, simply put, they do car stuff, okay? For those of you who do know a little bit about them, they make parts, subparts for OEM manufacturers, or I just actually used the same word because original equipment manufacturer, but whatever. So we know a little bit about the deal that they just made with LG and Apple. And so the thing is called the LG Magna train. And so that's going to be interesting when that rolls out with the Apple car. And so it's a little bit of getting exposure to this company or through this company to that product without actually buying Apple. Of course, there's also LG as well. But the point with that is we are seeing a little bit of a pullback here, and actually we'll showcase that in the price action. But if I could get this asset, which I perceive to be a good asset at a very good price, it may actually play a good role in the portfolio, right? Because we all know that I've been buying 3M and I am selling Honeywell. I'm taking the profits in Honeywell and I'm kind of looking for other industrial plays that I could kind of bring into the fold if they are at attractive prices. So we're kind of going to be talking about this today to see whether or not this is the case. Okay, before we actually begin, I think that a lot of the risks that might be faced is having to do with the supply chain issues. And we'll actually see if they do mention that. And we all know, for example, what's happening in the used car market. The used car market, the prices are rising drastically because, again, new cars, there's less of them, right? Inventories are down. And this is very concerning to us, right? So I think that, and I stated this in videos back in 2021 when we were just starting this channel, that supply chains will normalize, we believe, at about 2023. And this is not just me saying this. This is also Intel as a company saying this. AMD is saying this. Taiwan Semiconductor is saying this. So all this is kind of interrelated into one kind of package. So when we consider all these together as one thing, it starts to make sense. Companies like Magna, they're going to suffer alongside the supply chains. And there's other semiconductors that I actually want to take a look at going into the future. I'm going to be doing videos on them. One of them is Teradyne, all right? So watch out for that video. So with this being said, I actually want to take us over to the price action and we can start talking about what's been going on. So if we take a look at the price over here, we see a rise of about 300% since all-time lows, but obviously who's going to be the one buying it there, 30% down from all-time highs, and then the more recent one about 16% down, okay? So over here, let's go over to the actual earnings, or not earnings, but the investor presentation. And through the investor presentation, all numbers are in US dollars. Bringing us down here, we do see actually consolidated sales is going down, adjusted EBIT margin going down, diluted EPS going down drastically, about 54% there. Free cash flow also coming down 56%. So continued challenging operating environment right there. Yep, definitely there. So vehicle production, yep, you see there. Vehicle production change right there. There's our answer. So production is down. Why is production down? Supply chain issues. Is this a permanent environment? I don't think so. Again, I think 2023 is the normalization year. So we still have 2022. And then sometime in 2023, supply chain should be starting to normalize. And the company like this, if we can acquire it at a good price when the market's kind of discounting it, saying it's worthless, I don't want anything to do with it. We're like, yes, I want something to do with it. Give me the shares. Okay. So, okay, wow, they have the patting yourself on the back slide at the beginning. Easy to skip over. All right. So operational excellence, committed to carbon. Okay. Patting yourself on the back again. Accomplishments. That's also patting yourself on the back, but let's actually go through this. Award for, no. That's all patting yourself on the back. All these awards, I don't really care. I don't care. All right. So consolidated sales. Okay. So we do see an increase there, 4%. Adjusted EBIT margin. Oh, this is, by the way, 2021 results, because up here, this is Q4, right? So just the fourth quarter. Okay. So if you guys are confused and like, oh, why is it getting better there? It's because this is the full year. That was the quarter, right? That was the end quarter. Okay. So kind of adjustments going on there. All right. Q4 2021. Now you can kind of see here. Okay. And they're trying to do this thing where it's like, it's weighted. It's so weighted growth over market, and I'll actually zoom in here so you guys can read that with me, but weighted growth over market compares the organic sales percentage to the vehicle production change percentage after applying Magna geographic sales weighting, excluding complete vehicles to regional production. So when you take that measure into account, they actually grew. Look at that. So that's kind of funny if you ask me, but whatever. Sales, but I mean, it's good to see it. It's a measure. We know that they're not like hiding it, right? That was at the very beginning. They're like, yeah, we have less sales. Okay. But they're like, but it increased based off of this metric. All right. So consolidated sales, Again, Q4 versus Q3, it's an increase of 15%. And that is not off of that weird metric. That's actually, I guess, legit. All right, so Q4, skipping over free cash flow. Free cash flow, again, is probably obviously going to come down. Costs are rising. Producer price inflation has been higher than the CPI itself. But, here they're showing the return of capital to shareholders, 12% CAGR. So, if you're a dividend investor, there you go. All right, so going forward, I actually want to see this. Sales growth, continued strong sales growth over the outlook period. 90% sales in 2024 already booked. Okay, good. Margin expansion. Okay, good. I really would love to see this. Investing for growth, average annual engineering grows to 900. Yeah, because remember, they do a bunch of things. Okay, so this is their engineering business. Strong free cash flow. Okay, so we can kind of understand what it is that they're actually saying to us. 5.7 to 6.25 billion in free cash flow. That would be very impressive if they could get there. And look, notice how it's between 2022 and 2024. So that's in total, by the way. It's not per year. I hope you guys don't think they're like, whoa, and you go back and you see the market cap and you're like, undervalued. No. They're not saying that it's going to be every year. It's over the course of those 2 years. And so again, that's actually interesting because it's in that time frame that I think that supply chains are going to normalize. I think management is going to probably say the same thing. All right, so we do see, again, these are the vehicles that they're having a hand in and they're launching globally. You can kind of look through here and look, the Neo right there. Look at that Neo electric car, you guys. Neo. One of those new age electric cars. We have Fisker, Xpeng right there. Oh, look, some Chinese cars. Mercedes. Look at that Volkswagen. Jeez. Cars are looking funkier. All right, final outlook, key assumptions. I don't care about that too much. Okay, so, this is kind of like just fluff. Maintain strong value add is fluff. All right, so I think we're pretty much done here because it's just going to be fluff. But it's good to look through this and kind of see what they're trying to pitch as the sales pitch as to why we should invest. So if we don't see anything we like here, that's a negative sign, because this is supposed to be like the highlight reel. Like, oh, we're amazing. We're doing all these things. We're gonna do all these things. So we're gonna see their best face right here. After that, we're going to see how ugly it is. All right, so let's go over here to the model and look at that. You guys can see Netflix. Oh my gosh. Well, Netflix is gone now. All right, so MGA, let's see until it loads. And then for now, you guys, okay, there we go. Analysts have an $87.49 price tag on this thing, implying a 37.35% upside. That sentiment is oddly high. I bet no one's talking about this. And you know what? Let me go there. Yeah, no one's talking about it. We got one thing on StockTwits, one thing on Twitter. That's basically why. All right. Maybe it's even the same guy. Okay. You guys can kind of pause here and see if you guys see anything you like. And then you guys can look up this title and read these articles. But for the most part, bear of the day, Magna. So a lot of like, oh, they're selling off and stuff. Yeah. They just recently reported earnings in February, but not much is written about this company. You can kind of see here on the left-hand side. So we are actually not going to take the adjusted cash flow. So let's say no, thank you. Don't want to do any of that stuff. And let's go back over here. So this is a point that I will make. So if we discount it at the 15%, and obviously I don't think they're going to grow at 20%, guys. They are probably going to continue to execute on their buybacks, because I'll actually show that down here. They are a cannibalizer. And we can see here that the trend line is fairly positive, and we do see an estimate for cash flows to actually grow drastically in the next coming year. So again, as supply chains begin to normalize, that's what the analysts have projected, and sales are not normalizing, but growing a little bit, still kind of trying to recover to 2019 levels. So we are going to assume heftier growth rates. I think closer to like 10% is pretty fair. And I think maybe on the high end, they could achieve 20, and then we'll say 15% is, in between there. But high end is 20%, and we're going to weight it on the lower end, bring it down. We are going to assume some level of buybacks at about 2%. And then so it starts to become clear that we're approaching the prices where I would be fairly comfortable with. And so I'm thinking very strongly about adding this to the portfolio. Okay, because currently we're just there where I can almost assume a 5% growth rate, and I'm fairly confident that they are going to continue their buyback policy. Yeah, so I'd say that you don't be surprised if you see this position starting in the portfolio anytime soon. I'm actually thinking more and more every day about it, that potentially I'm going to be adding this company, right? Instead of adding too much to 3M, because 3M's kind of not coming down. It's not cooperating. 3M is just not cooperating with me. It's not lowering in price. It's just kind of staying where it is, slightly higher. I'm not really interested in adding too much more to 3M. Then this might take its place, and I might start adding to this one, and hopefully this one actually gets down there. But this one's a little bit more conservatively priced. I think fairly so, because 3M is of the two has higher moats, stuff like that. So, but that doesn't take away that this company is a great company. It is a fantastic company. And we'll actually go take a look at the ratios. And remember that we have to keep in mind what type of business we are looking at. So the current ratio is pretty good. Total debt ratio, the solvency ratios, pretty good. It's kind of range bound in some of these instances. Going down to the DuPont analysis, we do see gross profit margins are again range bound. So they kind of keep them steady there. Operating margins are also range bound. Net profit margins, again, range bound. ROA, ROE, these are the metrics I'll actually care about a little bit more. ROE specifically over ROA. ROA, I expect for this to be a little bit lower. ROIC, it is trending downward a little bit, but I hope it's gonna, be that 2017, and they can bring it back up to 2019 lows. But overall, in all, we do see that over long periods of time, it is doing fairly well, especially when we look at the earnings quality metric. The earnings quality metric is consistently good. It's never been below 1. So that's very good. Okay. So I do like to see that. We're not going to change the name of the sheet, but yeah. All right. So let's take a look back here and kind of have some closing thoughts. So I think Magna International is a very interesting business. It's a boring business, and a lot of these businesses I do enjoy. For example, Cardinal Health was a recent addition to the portfolio, and it's performed well. It's up, I think, like 20 something % in the portfolio, and that's a terribly boring business. No one really cares about that kind of company. And this one's another one of those that's boring. Same with LYB or Len. I can never pronounce it, but it's a chemical company. Boring business, performing fairly well. Rio Tinto, BHP, boring businesses, performing very well. Well, those were more in line with what I believed was a potential to capitalize on some scarcity on commodities. And I couldn't have expected that we would have entered some sort of like small kerfuffle with other nations, and that could also cause some uncertainty with resources. So that turned out better than what I probably had thought would have happened. So, but all in all, this is a good business. It's not the best business, obviously. I'm not stating that. And it's a good way to actually play the vehicle market like an agnostic player that will kind of work with anyone. It doesn't really care who really wins. It will just say, okay, well, I perform these services. Do you want my business or not? And then it will just help out whoever pays them the money, right? Like a mercenary. They're a mercenary in this war for EVs. Okay. So I'm excited about them. There's a video that I probably will do coming soon, and it's going to be on Cummins. So Cummins is a business that traditionally makes a lot of engines, a lot of diesel equipment, but they're also doing a lot of stuff for renewable energy and electric vehicles. So that will be interesting to kind of take a look at and see what it is they're doing, what the proposition is there. Because I also think that, on first glance, it's cheap, but we have to see like, well, how cheap? Is it actually cheap, or is it not really that cheap, right? Because remember, we don't want to fall into that value trap per se, where we see, oh, low PE, it's a value stock. No, that doesn't really mean that. I would say that in a lot of ways, Google has been a value stock for long periods of time. And then people think of that as a growth stock, right? Or, you can look at the portfolio, and I think that all investing is value investing, and people just have their definitions kerfuffled or not. I think they're, a little bit inconsistent, but, I think everything is value, right? And then we just are depending on what we think the growth rates are going to be. And that's very important. All right. But on that note, guys, I hope you guys enjoyed this video. If you guys have any questions, comment down below and let me know. Let me know if you guys have any concerns or, criticisms about what we discussed here today. Maybe I'm wrong. Let me know down your thoughts. What do you think about this company? Do you have any other stock requests that you want me to add to the list? Let me know. This one's not a request. This one is one I just wanted to showcase to you guys. I do cover a lot of stocks that really aren't talked about all too often in the YouTube space. Sure. Does it hamper growth? Sure, whatever. But this is a passion project at the end of the day. And so we're just having fun here. All right. On that note, guys, I hope you guys have a great one. I'll see you guys in the next one. Bye.